Hi and welcome to Swissquote's Daily Market Talk. It's Friday, June 20th. The US gives itself 2 weeks to decide whether to go in Iran and make the geopolitical matters worse. So risk appetite is a little bit better this morning as the US was thought to be intervening as early as this weekend, but the looming geopolitical risk should continue to give support to energy and haven assets in the final hours of the trading week. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the worsening global geopolitical weather keeps investors in a cautious mode and will likely prevent them from taking too much risk on their shoulders before the weekend arrives. While the news that the US is giving itself 2 weeks to decide whether to intervene in Iran or not, which is obviously slightly better than the earlier reports this week that they would just go in as early as this weekend. Looming uncertainties regarding the global geopolitics push US and European equities lower at yesterday's trading session. We also had some thin trading due to US holiday. Now, I'm not sure that the US buying itself time could be interpreted as easing tensions, but European futures are slightly better, but in Asia, perhaps due to mounting interest in European military and defense stocks, which particularly benefit to the German DAX and the British FTSE indices. Rheinmetall, for example, of Germany is now replacing Kering, which is the maker of Gucci bags, in the Stoxx 50 index. Energy stocks are also closely watched by international investors these days as US crude consolidates gains above the $75 per barrel level with looming upside risk. We start hearing crazy numbers again, as it is the case in all escalating markets, with some analysts out there pointing that the barrel of crude could jump to $130 to $150 per barrel range if Iran decided to block the flow of oil and gas flows at the Strait of Hormuz, where 20% of global oil and gas flows transit. Satellite images apparently also show that Iran is pushing its oil into the international markets rapidly these days. It's said that their exports surged 44% since last week compared to the past 12-month average. Certainly, they're trying to boost revenue and they are trying to act before any potential hit to their oil facilities. So what's happening right now rather feels like dark clouds gathering in the sky rather than the contrary. And the calm that we see in the markets today could eventually be the calm before a storm. As such, risk to oil and gas prices remain tilted to the upside. Natural gas just hit $4 per MMBTU at yesterday's trading session and is consolidating gains near this level this morning at the time I'm talking here. Gold is not performing as well as it did during the worsening trade headlines of the US, as some of the flows were diverted toward the US dollar and toward the US treasuries. But interestingly, the US dollar is also giving back some of its early weak gains due to geopolitical tensions, and the Swiss franc continues to amass safe haven flows despite the Swiss National Bank's decision yesterday to lower its interest rate to 0% to weaken the franc and give some support to these Swiss exporters that are heavily hit by a terrible combination of tariffs and a stronger Swiss franc. Indeed, Swiss watch exports dropped nearly 10% in May. Exports toward the US dropped 25% after an almost 150% surge the month before the tariffs hit. But exports toward the major markets, including China, Japan and the United Kingdom, fell for the Swiss watchmakers. So yes, the Swatch Group is not doing well these days, to say the least. The SMI's reaction to yesterday's interest rate cut was not brilliant either. The index is now preparing to test the critical Fibonacci support to the post-April 2nd rebound, which is the 38.2% major retracement and which stands near the 11,823 mark, and which distinguishes between the actual positive trend and medium-term bearish consolidation, is under risk today. And it looks like the SMI is well positioned to take that support out. Because the problem is, if zero rate policy couldn't cheer investors up for Swiss equities and prevent investors from buying the franc, there is not much the central bank could do. I like the Swiss real estate funds better, to be honest with you, when interest rates are so low and when international exposure is so complex. So in this situation, having exposure to a domestic real estate ETF is, to me, a good alternative for those looking to stay in the Swiss franc. Elsewhere, the Bank of England actually refrained from cutting its own policy rate at yesterday's monetary policy meeting in a broadly expected decision. But the composition of yesterday's MPC vote was slightly more dovish than expected, with 3 MPC members instead of 2 voting to cut the interest rates in the UK yesterday. So the message was super balanced in London. The MPC members totally reckoned the loosening jobs market of the United Kingdom, easing price pressures in services sector, weaker growth due to Rachel Reeves' heavy budget consequences, and Donald Trump's erratic trade policies and their implication on the UK economic growth. But the members also pointed at potential surge in oil prices due to Middle East tensions and high food prices, and 6 of them thought that it would be a good idea, a better idea, to wait until at least August to see if a rate cut would be justified. Fair enough, cable is back to 135 level this morning. The euro pound consolidates a touch below the 0.8550 level, while the FTSE 100 sold off under the pressure of rising geopolitical tensions. But note that the defense and energy stocks of the FTSE 100 should eventually give some support to the index in the worsening Middle East tensions. Overall, this week brought 2 more interest rate cuts than the Swiss National Banks to Europe. The Riksbank, the Swedish Riksbank, and Norwegian Norges Bank also decided to go ahead with lower interest rates this week to give support to their respective economies amid looming trade and geopolitical chaos of the moment. While the IMF said in a report published yesterday that risks to the European growth have shifted sharply toward the downside. The euro area will grow 0.8% this year, according to them, despite the European Central Bank's support and the European government's decision to boost spending in defense and military. They actually called for it. The size of push for deepening the single market in Europe. The problem is, well, the European governments these days are shifting toward the right side of the political spectrum amid the global geopolitical chaos and difficult economic conditions. So it is a bit complex scenario playing right now. Either Europeans realize that they are just too small individually to stand up against the increasingly aggressive big nations and big powers and stick together, or they will fall apart. But as things are so slow to move in Europe, I think none of it will happen in the foreseeable future. So the European Central Bank should realistically continue to do the heavy lifting in Europe. The euro dollar continues to benefit from the US dollar's overall weakness. The strong euro tempers inflationary worries in Europe, and as long as the dollar remains weak and inflation under control in Europe, the European Central Bank will be in a position to act. So is it a reason to continue buying the European stocks? Time will tell. Now, before we go, today is a triple witching day where futures and options on equities and stocks come to expiration all together and create higher volumes and volatility, and repositioning could lead to sharp market moves in the final hours of the trading week and also the following session. So be careful with that, but this is all for this week. I'm İpek Özkardışkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.